I'm just gonna like just raw share my screen here because um I kind of slapped together like a presentation, but then I was like, oh, I also want to pull up these dashboards. So are we good? Can you see it?
Yes, we can see it.
Yep, we can
Great.
see it.
Okay, so I guess the context or title is how Bitcoin native assets are affecting Bitcoin fees. Um, this is like one of the main narratives happening right now. So I love to talk about it. Some background on me, I'm gonna kind of like redo some of the talking points and slides I had last time. I think it was last summer in August. So some background on me. I co-own and operate my own proprietary Bitcoin mining operations here in the central U.S. I happened to like, how did I get here? Well, I just happened to be hanging out on Discord with Casey before we launched Ordinals, and I was just around, and I think I was like the only competent person who knew how to run a Discord. So he kind of tapped me, and then that ended up kind of redirecting a lot of my personal focus. I still operate my own my own mines, but then I was helping in the background build this new thing called Ordinal Hub with a couple acquaintances, which then Luxor purchased, and I just came along with it. And now I work for Ordinal Hub under Luxor, and Luxor's got a bunch of different business verticals, and Ordinal Hub is just kind of this one within that, and we're figuring out how it fits into the broader Luxor business model. I'm not a dev, and I like to joke, but you may have seen me post what I call mempool TA on Twitter. But I think it's kind of poetic and funny because like that's kind of what we're talking about, which is like having insight to fees. So like I would say anything's on the table. I'm joking about doing technical analysis on the mempool and block weight and stuff like that, but like that's kind of where we are. So maybe it'll turn into a more sophisticated study. As I said last time, ordinals are kicking off a new era of rapid price discovery for Bitcoin block space. I think this is not news to anybody here anymore, but like the whole narrative has been transaction fees on Bitcoin have to pay miners. Bitcoin as a network has, in order to succeed, has to sometime in the future transition to being primarily fee driven. And consensus has been this has to happen in like the next decade. What's very interesting is that we're starting to see little inklings of this. And as we know in broader crypto, like what starts off as a goofy side narrative can emerge into like a core backbone of an ecosystem. So we're having a very rapid, chaotic discovery of the value for this block space. I also said last time that I use this analogy of Pandora's box, where like I feel like Casey's going to get credit for quote solving Bitcoin's security budget, but and I think he deserves, if he's the one who gets credit for it, then so be it. He's the one who deserves it. But I like to think of it like this: Ordinals really just kind of opened Pandora's box because, like, we're looking at rollups now, right? Rollups don't really have anything to do with ordinal theory, but they do have more to do with the inscription envelope mechanism. So this is the secular trend of data on Bitcoin and new types of assets on Bitcoin. And Casey opened Pandora's block box, and the first thing that flew out was ordinals, but like now we see more sophisticated use of block space. So that's like the narrative I have. Here's also something I talked about last time. I said with regards to like the BRC20 and fungible tokens, it's like the transaction time preference got moved up significantly because of ordinals. Like people needed their BRC20 transactions to get in the next block. These are very urgent timeliness to them. But what we're seeing now is that we're actually having a more dynamic, multiple types of transaction time preferences. And I say I will categorize these into like low, medium, and high categories, and we have different average transaction sizes, different like efficiencies amongst this, and so we're seeing a more diverse, um, like more diversity in the types of transactions and the timeliness of them. And this is a chart from our hash rate index premium. Hash rate index is the Luxor market research side of the business. This is a chart which kind of gives you the idea. It's a simple macroeconomics chart. It's very familiar. It's a supply demand chart where supply of block space is static, and demand is what has shifted. So we have this simple supply and demand curve where pre-ordinal inscription demand has a curve of, or has a line of X, and then post-ordinal inscription demand moves demand line up. So therefore, the pricing of block space increases. This is the simple. This is all you need to know for macro. And then, this is also another one where we just kind of categorize different things that happen on Bitcoin and their effect on transaction fees. More demand for payments, trading, confirmation times, and smart contracts / DeFi, those increase transaction fees. Ordinal inscriptions obviously increase transaction fees, but like we have efficiencies that we also have on Bitcoin, such as Taproot or SegWit, where we either change the pricing of these transactions or make them more efficient from a data structuring standpoint, and that would decrease transaction fees. So what's interesting is that even though the transaction fees have increased, overall transaction efficiency has also improved. So as more people use Taproot, so it's just more efficient. And then layer 2 is also theoretically net reduce transaction fees on Bitcoin. So we're in the middle of a crazy fee spike, and like the dust hasn't really settled on it yet. So I haven't really been able to like pull apart, and I don't think I can add too much like specific character on what's happening right now. But we can go back and back test and look at the past year. My main takeaway is that we've matured and diversified from a single, what I call shitcoin fungible token protocol, to an abundance of shitcoin meta protocols on Bitcoin. This is significant, and I think that this is the signs of a healthy and emerging fee market. I like to imagine that something may start off as a shitcoin and then evolve into a very serious ecosystem. We've seen this. Like I look at like a lot of people used to call Solana shitcoin, but now it's in the next couple days it could become the third largest crypto economic ecosystem, which is quite remarkable. So I think we could see this with these other kind of fungible token protocols, which are crowbarred into Bitcoin right now. So I was gonna try to embed some pictures, but instead I'll just pull up a bunch of dashboards. We'll start with hash rate index. So hashrateindex.com. This is a Luxor research product, and the first chart we have is hash price. This is basically the primary metric Bitcoin miners pay attention to, and it's a function of a unit of hash rate, how much that unit of hash rate generates in US dollars per day. And we can see this chart. It's basically a chart of profitability per unit of Bitcoin mining over time. And then I think I may have accidentally zoomed in too much here, so it doesn't have the present data. Yeah, so we actually see what seems like a giant fee spike in the past few days has it has translated to an increase in hash price, but not nearly as much as a lot of people think. If we zoom in more, this is that fee spike. We can look at it. So it is net. It's more significant net revenues to Bitcoin as percentage of fees to block subsidy, but in terms of like the historical profitability, we have not yet approached the two previous large events in the post-ASIC era of 2017 and 2021. The next chart I want to have pull up is block time. This seems intuitive and simple, but block time is stable. This cannot be underestimated that we're still in an average of 10 minutes per block, slightly under that. And that's just because of Bitcoin's difficulty adjustment. So it's just remarkable, I think, year after year, as the nature of the things on Bitcoin change and evolve, some things do stay the same, such as Bitcoin's issuance and its block time. average Bitcoin network transactions, obviously we see post ordinals here. But what's more interesting is actually, if we zoom in a bit, um, ordinals started back in February of this year, and we didn't see really a net increase in Bitcoin transactions until the fungible tokens hit. This is the BRC20 effect in May. You see this end of April, beginning into May. That's notable. So this is not JPEG demand. I do think JPEGs, when I say JPEGs, being like the visual inscriptions, JPEGs do play a role, and they are a major part of the story. But they're not like when people talk about fees, it's not really just the JPEGs. I think to a lot of people here who focus on the ordinals ecosystem, this is intuitive. But if you aren't, and you'd be surprised how many of like the large public Bitcoin mining companies are not this dialed in. This could be a surprise. And then the other one, this is for me the big one. Bitcoin transaction fees as percentage of block reward. Let me in. Okay, just to get on the screen, I have to zoom out a bit. This chart right here. It's intuitive to us that we see transaction fee spikes during bull markets. 2017 here, 2021 here. But what is not, we've not ever seen is that we've not seen this happen in a bear market, because I would say we're still recovering from the downturn. And this is a cyclical industry, cyclical ecosystem. And we are now approaching all-time highs for the block reward, where the fees per block are now regularly and intermittently surpassing that of the block subsidy. This is significant. Imagine what happens, and I talk about this at the end of the presentation. Imagine what happens when we actually enter a bull market. I think this is one of the greatest places developers can focus, is solving the problem of an ecosystem which is not at all optimized for efficiency, and it is not prepared at all for a high fee environment. So my favorite dashboard from Data Always, if you don't follow them on Twitter, this is a must follow from a data analytics standpoint. The two, all-time fees, 156 million in fees to miners, network fees as part related to inscribing. Where is the other one? Here it is. Daily inscription spending. Sorry if it's a bit chaotic as I jump around here. We are now spending like 6 million in network fees a day. And if we were to like, I wish I could actually quickly take a different snapshot of a different time period. Like this, what we see here over the past month and a half, 2 months, we saw this happen in May, and we also saw this happen a little bit in February, early March. It's just the magnitude of these cyclical fee events is much more significant each time. And we can see this black line here. Basically, the ascent of it describes the how many fees per day are being are on the Bitcoin network because of inscriptions. Then the other chart, and this is one of my favorite charts, I review this on the Ordinal Hub Weekly Roundup every week, is this chart, where we get a little personality into what types of inscriptions are being inscribed. And the two big colors here are obviously bluish purple, which are image or PNG JPEGs. I use the term JPEG encompassing, where prior to BRC20, the majority of inscriptions were images. Then BRC20 happens, and a lot of these now become BRC20 mints, this orange category here. But then look at what happened here. In October, we actually have a resurgence, 5% of inscription transactions that are happening. We have a resurgence of image transactions. And why is this? Well, if we look back at the fees on Bitcoin, fees plummeted during the month of October. So we actually saw renewed interest in inscribing. We saw net more image type inscriptions happen during this period because the images, the JPEGs, are more price sensitive. They are more they're more time agnostic and price elastic than the more price inelastic fungible token inscriptions. So I think this is pretty significant. Um, I would the last chart I want to go to is from Merch. He's a well-known Bitcoin developer, and that's just a little snapshot of like how many of these transactions are which. Gray is normal transactions, purple, blue are BRC20 transactions, and orange are inscription transactions. So we see, you can see a little bit of personality here again, where um, regularly over half the transactions on the Bitcoin network are inscription related, ordinals related, and we see in during periods of more orange than blue, those are periods of low fees where images, JPEGs, actually take up more uh, like transactions by number than the fungible tokens. So it's an interesting like personality we're seeing develop in the ecosystem. Let's analyze previous ordinals fee spikes. The one I think everybody forgot about, this was like the first shot across the bow, was the DeGods mint last March or April. So we executed this for DeGods. Basically, there was a certain block height where at that block height you submitted a bid into this kind of auction system, and the first transactions which were above a certain threshold to mint to pay for the DeGod got to win the DeGod. And we saw a lot of people not really understand the mechanics of this, that higher fees, in contrast to Ethereum, higher fees do not always mean that you, uh, there's not like a linear relationship between the more you pay, the higher position you get put into a block, either in the transaction index within the block or just next block. So we saw people just jack up their fee rates and yeet them onto Bitcoin, and it caused this really interesting like 3 or 4 block fee event where we saw like a 9 Bitcoin block, which was like the DeGods block, and this was like for me the first real fee event on Bitcoin. Then we saw the May BRC20 run, which was another fee event. But I actually have a contrarian hot take on this that I don't think a lot of people have admitted yet, or even really looked back and try to analyze. This is from Galaxy Research. So the hot take is that the fee spike last May from BRC20s was not was driven by BRC20s, but the people who paid the fees were not actually BRC20 transactions. BRC20s actually almost like um, tricked normal financial transactions, normal Bitcoin users into overpaying. So we saw this black here are the BRC20 like ordinals overpayment of transactions. Basically, we're gonna evaluate um, like in order to get into a block in the next few blocks, you only reliably need to have a transaction within a range. And overpayment is defined as you just way overpay because you're not that dialed into how to like optimize your fee. So what happened is that the ordinal overpayment was minimal, this black here, and what happened after you saw a spike in ordinal overpayment, normal financial transactions started overpaying dramatically, because what happens is now normal users and exchange UTXO consolidations are bidding against each other because they're relatively unsophisticated. We've not had really a sustained high fee environment for like 15 years on Bitcoin. So nobody's had to like actually figure out how to not bid against themselves. Binance, I think, spent something like 20 or 30 Bitcoin unnecessarily in a couple days by just throwing like hundreds or thousands of consolidation transactions out, which then at the same time, which then estimated fees against the previous one. So they just like caused themselves to kind of chain overpay. It was a very interesting event, and that is like what happened here. And I think we've seen a little bit of response and optimization to this scenario, but I I still think there's like a long way to go. Here's just another snippet from that Galaxy research report. Transaction level data indicates that most of the fee pressure from April to May did not come from Ordinal's BRC20 users, but from, quote, regular Bitcoin users. Contrary to popular belief, during the large fee spike period, regular users of the blockchain making what are referred to as financial transactions were largely responsible for pricing out Ordinal's transactions. That's the contrarian hot take. Furthermore, the chart below illustrates that Ordinals never represented more than 30% of total transaction fees for miners, despite representing more than 70% of mempool volume. So I would say you can both say these new type of digital assets, Ordinals, BRC20s, are responsible for the high fees, but they're not the actual payers of the high fees. That, to me, is the correct take. I won't read all this, but basically this says that we're seeing different behaviors in low time preference users and high time preference users. We have a time preference premium on BRC20 transactions. I think going forwards, I'm going to start saying BRC20 like transactions, because the narrative this past few months has been a diversification of the fungible tokens and types of assets, which are time preference premium. So I wish I were ready to do a more deeper dive on the current fee landscape, but you can sum it as like shit's high, yo. It's like very expensive to use Bitcoin, and I don't think people are ready for it. The main takeaway from the past month or two is that it's no longer just BRC20. It is BRC20. It's Atomicals, it's Runes, Pipe, Runes X, Runes Beta, whatever those things. Cases Runestone hasn't even come out yet. That is like months away. Stamps was the main one this past couple weeks. CBRC20, BRC100. It's funny because like I'm a prominent critic of a lot of these, but I'm just a technical critic. I'm also more of an analyst, and I love to see people throwing stuff at the wall and trying things on Bitcoin, because like we don't ever achieve a more sophisticated block space market without people actually using things. So I think I can be both a technical critic and an enjoyer of these types of transactions. But what we're seeing is, in contrast to last May, and in contrast to that DGods mint, we are seeing low and high time preference transactions. BRC20 type transactions are price inelastic, high time preference. JPEG transactions are low time preference, highly price elastic. This is pulled from a kind of goofy thing that I tweeted a month or so ago, but I like to imagine, here's, mempool.space's chart of like block weight over time, like what the block weight within their mempool looks like. And I like to imagine that there's this like kind of strata at a certain fee rate range of like building JPEG demand, which is a buyer of block space of last resort. This is a fun like term that people in Bitcoin like to use, that Bitcoin mining is an energy buyer of last resort. We buy the cheapest energy anywhere. Well, now JPEGs are like this time elastic, time agnostic block space buyer of last resort, where once we get down to like 20 sats for VByte, if we ever get there again, I know hundreds of megabytes worth of collections and data which want to get onto Bitcoin. So they're sitting on cache. They're ready to inscribe these JPEG collections, and they want to pay. They're not going to pay 100 to 200 sats for VByte. They're going to pay 30. They're 100% going to pull the trigger at 10 if we see that. So we now have like a sustained floor of demand for block space. This is significant. I tweeted the kind of version of this, but basically, I've got quote boots on the ground of the JPEG inscriber world. Let me tell you, there's tons of people with cash on hand to launch large data heavy projects and collections. These are time agnostic, and so they are significant. These JPEG enjoyers are the first significant marginal buyers of block space. So, whereas BRC20 is I've said this so many times before, but I didn't realize how many times I put it in the presentation. And then I think there's a couple metas emerging. There's the Right now, the current meta is that there's cyclical fee spikes with a poorly optimized ecosystem for broadcasting, constructing transactions. This is going to be very, very iterative, very rapid, and there's going to be a lot of development. Every quarter, it's going to look very different. Try not to tire yourself out. I use this term Bitcoin accelerationism to say we are accelerating adoption of Bitcoin, and this is going to feel chaotic. It's going to look wild, and it's going to be hard to see the forest for the trees, because there is a future meta at some time. I think it's going to be 3 years away at least, where we have a more stable and predictable block space pricing, more financialized block space markets, and then sophisticated and efficient transaction construction. I think this is a very, very quick glow up or grow up few years for Bitcoin. And then the last two thoughts I have are, as I kind of close this, is that nobody is prepared for fees to spike. Wallets, exchanges, users, UTXO management, fee estimation is way off. Like I don't know how much you've been broadcasting large transactions on Bitcoin, but like fee estimation really gets distorted, especially at these higher levels of 100 to 200 sats per VByte. The entire ecosystem, I say, is quote whack, and we're 15 years into things, and nobody has even begun to imagine what actually happens when fees go up. This is a problem, and there will be massive demand to work on and solve these issues. Bob Bodley had a good comment regarding the May fee spike, just on like the distortion in fee estimation by type of user and by wallet. Um, how does this impact you guys? Well, there is so much opportunity to focus on transaction fee estimation. Um, I would call this like high fee environment solutions. Like even the big guys, Coinbase, Binance, they're like bidding against themselves as they consolidate these UTXOs. These guys need hand holding by people familiar with working on Bitcoin because they sure are not ready for this either. I call this like fee optimization mitigation developer as a service. Like this is a new type of thing I think you can do this coming cycle is just be very good at helping reduce these people's expenses or maybe your own. And then also if you're building something right now that relies on low fees, I would say figure out what your strategy is because you need to prioritize how to fix this as soon as possible or you could be locked out. Like this is a case with a lot of like the legacy Bitcoin companies. There's like a lot of like the hardcore Bitcoin maxi companies who like provide DCA services, like on-chain, like multi-sig services, and they are not prepared for a high fee environment. And it's almost like they've been hoping for fees to go up, but also not ever actually preparing for it. So, um, I would just recommend like if you're building things right now, model what your business does at a sustained 200 sats per VByte at a 1,000 sat per VByte pricing model. Um, Imagine what if we spike to thousands of satoshis per VByte. What does that do to your business? Maybe you pivot, maybe you further optimize. So these are very important things to consider for you guys right now because I think they're gonna happen in the next 2 years. And that was kind of what I've got. I'm open for